Yeah. Hi, good evening, everyone. My name is Faiz Wahid. I'm the director of P Manifold Business Solutions, and I welcome you all to this first webinar of P Manifold on solar financial modeling. Uh, and in this webinar, what we try to do is to share the knowledge that we have gathered in the areas that we work. And I'm very happy to note that a lot of people have been able to join us from different parts of the country. Let's move on to the next slide, please. Just a quick intro into the agenda for this session. I'll be just walking you through the agenda and also introducing you to the speakers for today. We have a very esteemed panel with us. Um, First, Mr. Ankit Agrawal will be talking about solar opportunity in India and walk us through the building up of a solar financial model, discussing the key inputs and outputs of what a model should look like. Uh, Secondly, Mr. Dinesh Natarajan of Suitless Energy would speak about the risks and decisions involved in developing solar projects, and his talk also includes a case study that would be interesting to look at. And following that, we will have a moderated Q&A session wherein all the attendees are invited to ask questions, and the panel would be uh, requested to answer them. Uh, Moving on to the next slide. Just a quick brief overview about P Manifold. The company was incorporated in 2010 and is a research and consulting firm focused on providing market development services to clients that are engaged in new areas, new markets where new business models are being tried out and industry reforms are taking place. Particularly so in this session, we are looking at power as the sector and solar as a new business model that is emerging. Uh, the clients range from developmental sector areas of power, health, education, and few others, and the services range from intelligence assessment to engagement, which cover the entire market development life cycle. The topic for today is solar financial modeling, and the broader topic of solar, as we see, has received a huge government mandate around the development of gigawatts of solar power. What is more encouraging is the involvement of private sector in this space. Uh, the challenge here is the highly dynamic technology landscape, and both of these provide an opportunity for organizations to innovate and develop new projects. The opportunity scale from rooftop levels, rooftop level projects, as well as megawatt scale, which are like grid scale projects. So the question really is how do we evaluate such projects at an early stage? Due to high capex involvement, you would want to evaluate these projects early on, and that's where a financial model really helps. The speakers for today are from P Manifold Business Solutions and Suitless Energy. Just a quick introduction to the speakers. Uh, Ankit is basically an analyst. He has been involved in developing market assessments and business modeling and evaluation projects for P Manifold, and has worked with multiple clients on solar financial modeling. He'll be walking us through the model building aspects of the critical inputs and outputs uh, and the simulations involved in a solar financial model. Whereas Mr. Dinesh Salim Natarajan, who is the co-founder of Suitless Energy, uh, He is the ex Vice President and Head of Transmission and Storage Development at TerraGen Power in the US. And he co-founded Suitless. He has over 16 years of experience in the US energy sector, and he has also led the development of large-scale advanced grid storage projects, hybrid storage involving solar, wind, natural gas projects, and also grid transmission projects. So I would, without taking further time, jump into the first session, first presentation for today. However, just one more thing before we start is you see a small box on the right bottom, I believe, which says questions. And I suggest that all attendees, while listening to the presentations, keep sharing their questions, which we will gather and ask the panel speakers to answer upon. We may not be able to answer all the questions that we receive in the session itself, but we will take those questions, and in the post event proceeding, which we will be publishing online, we will ensure that the speakers also answer those questions which remain unanswered in this session. So quickly moving on to the first panelist of today, Mr. Ankit Agrawal. I request him to start with this presentation.
Thank you first for the brief introduction and giving us this opportunity. Good evening to everyone, and I hope my voice is audible and you are able to see my screen. So like talking about building a financial model for your grid scale or rooftop project, the flow of the session will be something starting with solar opportunities in India, why financial model is important, what are the critical inputs and output parameters of solar model, and walkthrough of P-manifold solar financial model. So talking about the solar opportunities in India, so if I see the current status quo of renewable energy, India capacity stands at 43 gigawatt. Out of this 43 gigawatt, 7 gigawatts is from solar. Now, like if we see the government mandate, which is targeting 175 gigawatt of renewable energy, 100 gigawatt coming from solar. So current situation is 7 gigawatt and we are talking about 100 gigawatt by 2020. So it's almost 15 times. So the opportunities like in terms of in the next 6 years is going to be tremendous in solar space. Out of this 100 gigawatt, 40 gigawatt is going to come from solar rooftop. So if you look at the overall graph, so if I have to see the targets given to the different states, Maharashtra, Uttar Pradesh, Tamil Nadu and Gujarat, these 4 states in itself basically accounts for almost 40% of the solar rooftop mandate which is being given by the government. And considering the state like Maharashtra, where the power tariffs are one of the highest in India, the opportunity becomes much more favorable in terms of the investment and the ROI we are looking at. The second most important aspect is solar rooftops or being also the alternative to power backup solutions, DG sets. Now if I compare this cost economies of this DG sets with the solar cost, DG diesel generator, it will cost you around rupees 12 to rupees 15 per unit, but whereas the solar is cost around rupees 4.5 to 6 rupees per unit. So again, in terms of the savings, it's almost we are talking 50% savings when you compare with your traditional alternative backup solutions. Second aspect, and a very important aspect, if we compare the cost of solar with your commercial tariff or the industrial power tariff, the trend is solar cost has declined very rapidly in the past years. Now there is some kind of stabilization coming in the solar power tariff, but if we compare a normal power tariff or the grid power tariff, they are increasing. And if I see those tariff inflation is, you know, range from 4% to 14%, which depends upon the discom or the state discom losses. The good thing is about a lot of unutilized space, if, government buildings, huge wastelands are available, which again open the new opportunities for rooftops in India. Moving to the next slide. Now, if I compare one fact, basically, which is energy per capita. In India, the energy per capita is 765 unit per capita. If I compare this energy capita with the China or the USA, which we are trying to position or compete, almost it's 5 times China. China is 5 times of India, whereas USA is almost 15 times of India. So the energy demand is going to rise, and in that case, renewable energy sector is going to play a very important role in meeting the future energy demand. Now, if like what are the incentives for DISCOM? If I look at the data available, the DISCOM losses are around rupees 62,000 crore as on March 2015. It's a huge loss. So most of the losses are due to transmission, commercial losses. And if we look at a state level, there are 12 states which are loss making and 9 states which are profit making currently. So it also provides incentive for DISCOMs to reduce their losses and promote solar policies in there. And what is being taken by the government, to promote this solar policy? So there are various prices being announced by the government targeted to DISCOMs, distribution franchisee, private institutions, financial institutions, channel partners, private developers. Just to state a few, like the DISCOM, which provides highest number of net metering connections, is awarded some cash prize of rupees 5 lakhs, 10 lakhs. And if I sum up the total award which is being given to different players, stakeholders in form of cash prizes, almost 524 lakh rupees. So there is a favorable environment in India, which is expected to grow further and boost the current status of solar market in India. Now, if we look why a financial model is important and how is it helping, the first and important aspect is any financial model is based upon certain set of assumptions. No financial model can be built up without any assumptions, and it is very important that these assumptions can be vetted by third party or a group of experts independently to see the validity of the model. So financial model allows you that purview where you can vet your assumptions, what you have done, the financial model comprise. Second is reference modeling. When I say reference modeling, lot of data points you need to capture from the database sources. So it is very important to understand how credible is the database from which you are going to fetch your information, because like in a open technology, it's very important you make use of a very credible data points. Which more credible the data source, more accurate is your financial model. So data source becomes very important in case of financial modeling. Now in solar systems, we are talking about 25 years of life cycle. So what is the cash flow you are going to project in the next 25 years? How your company is going to perform in the next 25? How you have to allocate your internal funds to match the project cash flows? So that is something a unique thing which financial model allows, where you can project your cash flows and estimate your fund requirement and you manage your internal company expenses. Then since I have worked on a lot of financial models, one very important aspect every financial model needs to be incorporate is the ability to give you a decision making and evaluate project risk. So when I say ease of decision making and evaluate project risk, how you can test your different business case, because your one consumer profile may be different from the other profile, especially in solar. So how this both cases are different, how it is going to help you, what kind of risk you are able to match up, maybe pessimistic, median, and optimistic scenario. So if your risk taking capability is between the pessimistic and optimistic scenario, then it helps you in a decision making, saying yes, okay, I can go for the project. But even in a worst case, if you are not able to get those viability of the project which you are looking at, then probably you should reconsider your decision. So this is why like a financial model gives you a top level of overview to understand your dynamics of the project and how different parameters are going to influence in and out of the model. So to take away to the next step, like what are the critical inputs of solar model? I'm going to, first is very important aspect, since we are talking about solar, what are the solar system specifications or related specifications we are talking about. So first is solar insolation data, like the amount of solar radiation energy on a surface at a given point of time. So what I have seen like in financial model is one way is, people generally have their own set of assumptions, say like 5 kilowatt per meter square or something, and that's a manual entry you make based upon your judgment, whatever you have read from the online or the resources you have. The second is something, there are also credible data source where you can create your own set of APIs, and based just by entering the location of your site or the city, you can fetch the insolation data. So now this like fetching data from credible data sources like made available by NASA, it becomes more easier for you to like validate your assumptions. Then second is solar degradation factor, the rate at which the solar output is expected to decrease over time. Now again, there are different ways you can tweak the solar inputs. So one is some uniform degradation rate. When I say uniform degradation, say it's every year my solar output is going to decrease by 0.5% every year. So in first year if it's 100, second year it will be 99.5, 99% of the rated capacity. So it's a uniform degradation. But someone may not agree with this assumption, and you may want to have a different degradation over a period of time in a block wise. For example, you can say for the first 10 years, my degradation factor should be 1% every year, and for the next 10 years it could be 0.5%, and in the next 10 years again it could be 0.67 or 0.81%. So it totally depends how you want to vary your degradation factor over a period of time. Why this is important is because every assumption you make, this changes the overall capacity of solar output you produce, and that will directly impact your revenue and in turn your overall project viability. So how you want to tweak those models, that becomes very important to understand, and what manufacturer, what warranty your manufacturer is providing in this case. Then the third critical factor will be project cost and subsidies. So basically it should cover your land and construction cost. Land, it could be on a lease, or if you're buying the land, you can also consider that. Second is what insurance and pre-financial charges you need to incur if you're going for a large projects. You need to complete the overall technical and process. So what kind of pre-operating expenses you will already incurred? What are the central and state subsidies available? Balance of system is one of the area where you have to consider your cost. So all your cost elements should be considered in a one single sheet, which allows you to capture your all information about project cost. Then financial structuring in large projects which require huge investment of say 1 megawatt requiring a 5.5 to 6 crore rupees. So what portion of your project cost is going to come from debt and equity becomes important. The reason being, every debt is going to add some value to your per unit cost of solar. Then at what rate you are going to get your interest rate, what is the tenure, what is the moratorium period. So all this factor is somewhat needs to be accounted into the financial model where you calculate your all interest expenses, and when you prepare a project level profit statement. Then the next is power tariff agreement. Now again, in this a lot of different variants can be there. First is something a developer or a investor enters into a direct agreement with the consumer at a fixed price, that is a feed-in tariff, and states like Karnataka, where DISCOM enters into agreement, there are two types of tariff available, with subsidy and without subsidy. So flexibly, your model should be capable enough to allow you to adjust those changes into the model. If for the rooftop projects, again it depends, like your consumer category state, in which category does it belong, whether is it a commercial, whether is it a residential, whether is it a other category, because every state has a different power tariff. Again, it varies from category to category. Then what is the average monthly power consumption? At the end, when we are talking about net metering, then it becomes very important what is the monthly power consumption of your target consumer. Higher the power consumption, higher the bracket is going to fall, and better is the saving or the benefit he is going to see from the solar rooftop. Then what kind of agreement when we are talking about the tariff inflation? So that again depends, if you are entering into a feed-in tariff model, at what rate you are going to revise your power tariff norms. Then this is the next is tax and benefits, which is I think most of the most important aspect from a company point of view, where government is providing a 80% accelerated depreciation schedule, and recently there has been change, like now person can depreciate entire asset within the 2 years. So that is attracting more investment in the solar sector. So how is it being calculated, how it has impacted your overall P&L, how is it going to provide you tax savings? So that becomes very important to calculate, because this will impact your cash flows and all when you connect all your worksheets of the financial model. And then MET, this is minimum alternate tax, which is applicable for company. So if you are generating some revenue at the end of the day, so you are liable to pay a minimum alternate tax. So how your, even if you are getting a benefit of accelerated depreciation and all, how your MAT is going to behave, how your, because you have to pay tax, that's again a cash outflow. How you manage this, that needs to be understand your tax liability. So these are the key elements of a good solar model which I have seen could be incorporated in any model. Now coming to the critical outputs of solar model, at the top level one should have the summary, like what is the revenue he has generated from the sale of power, or savings if we are talking about the rooftop from an individual consumer point of view. What is the revenue from REC certificates, renewable energy certificates? What is its O&M expense over a period of 25 years? What is the interest the overall project needs to incur in its life cycle? So at the top level, this number helps you to get the overall viability. Now talking about the key performance indicators, yes, project payback and IRR are the ones which is a very must for decision making, like whether actually it is a viable business model for you or not. How much solar units you are going to generate in 25 years, considering all those factors like solar degradation factor and everything. Third is annualized average cost of power generation for 25. This is very important, I think. What is the per unit cost of solar, which everyone keeps discussing. So this is something we need to like calculate and consider this KPI and relate with the power tariff and the target state where everyone is working. Load factor, because it becomes important from the operational point of view, what load factor we are operating. Debt service coverage ratio, this is a very important ratio which like from the bankability point of view is important, where every bank generally looks for what is the DSCR ratio when they are looking to fund the projects. So one should also, is a very important KPI one should calculate when he's looking for financing options basically. Now this is a scenario analysis which I just try to put in. What I have done is, so it's a 2 variable analysis. In this, for a solar rooftop, what on one side I have considered a consumer profile of like its monthly power consumptions, which varies from 70 units to 300 units per month. And on the other side, I have considered 3 states, Andhra Pradesh, Karnataka and Tamil Nadu. And I've tried to calculate a payback period for this. So for this, it's a 1 kilowatt model. It's a very small scale implementation I've tried. So if you see, no policy is good or bad, whether we can say Andhra Pradesh is good, Tamil Nadu or Karnataka. It totally varies from your consumer profile. If your consumer profile is of 70 units per month, in that case, Tamil Nadu is the worst in terms of policy. But if I say average monthly consumption increases from 70 to 300, in that case, Tamil Nadu is one of the good opportunity. The reason being because in Tamil Nadu, if you produce any extra solar, you are not getting compensated. So in that case, it becomes important to understand where your consumer profile lies. So just now going through walking through of a P-manifold like solar financial model which I'm developing currently. So this is the input sheet. Basically the idea is to capture all the project related parameters at one sheet, say project generation, derating factor, investment details, operational details, revenue, loan terms, tax and benefit applicability. We capture at one place. Whatever as a user is something one needs to change the inputs here, and everything is interlinked to the other worksheet. So you don't have to change other worksheet, only what gets impacted is the main input sheet. Rest remains automatically populated. So no manual intervention required basically. Then the other worksheet is basically project cost sheet, which covers your all the aspects of the key elements of a solar project. Then again, the third is a solar generation and revenue estimation sheet, where you project how your solar output is going to vary and the revenue accordingly. The other worksheet, generally a typical financial model should contain is a depreciation schedule, profit and loss, balance sheet, cash flows, internal rate of return, payback, and other important ratios related to financial modeling. This is a very important, again, a slide. What I was telling you is, fetching the insolation data by building some APIs. So in this, if you see, there is a enter location where Florida. So what we just do is enter the state location, you get the geo coordinates. You can see it's minus 81.5, 27.6. Based on that, you can fetch the solar insolation data and you can use those data into your assumption. So this is the API which we have integrated to bring the more make the assumptions more robust basically. Then second is a simulation case where you can see Andhra Pradesh and Karnataka being compared, inputs keeping same. Just wanted to see like which policy is good, even if I consider both the inputs same. In this, average consumption was assumed was 300 units, but if I compare the payback, I see Andhra Pradesh payback is less than Karnataka. This is because the power tariff in Andhra Pradesh is higher, due to which the savings are higher and the payback is less. So that's the reason when I started, I said it is very important, like what is the power tariff your consumer is going to operate and how is it going to impact basically. So such kind of simulations you can do by changing, you can test one case for base interest rate, base plus 2% interest rate. So different cases you can evaluate through different simulation studies basically at one go. Now just to sum up my overall presentation. So solar market, I believe, is expected to grow by 15 times of the current capacity in next 6 years. Cost per unit of solar is lower than commercial and industrial power tariffs, due to which commercial and industrial business segment seems to have good potential going ahead. Financial model is an important tool because it helps to evaluate your user profile, understand business risk, test your pessimistic and optimistic business case, and takes decision accordingly. At a concluding note, a good financial model should have involved industry best practices. It should capture all critical input and output parameter at one place, should have proper referencing and use of credible data sources, and should be vetted by experts to for cross check and make your model more robust. Thank you. If you have any questions, you can post on the message and I will be happy to answer those queries. Yeah. Thank you.
Hey, thanks Ankit for that lovely presentation. The uh, the financial model is a difficult thing to put together, and I think you tried a good uh, job to really put up the critical inputs and outputs for required for the solar financial module together. Thanks for that. And I also see questions flowing in already. Just as a note, the questions we will take them up at the end of the second presentation. So now I invite Mr. Dinesh to start with his presentation.
Hi, good afternoon, everybody, and I definitely very excited to be part of P-Manifold's webinar, and glad that so many of you could join this session late in the afternoon after a long day's work. That being said, let's jump right in. Just a brief note about Suitless Energy. We are a company that is founded by professionals with background in the energy sector and in the IT infrastructure, cloud computing areas in the U.S. And we started Suitless Energy about a year ago. Actually, this week will be our first anniversary week. And we wanted to differentiate ourselves in the market by offering the most reliable technology that is out there, so as to ensure that the projects really do work for decades to come. And we differentiate ourselves in this market by also offering the longest end-to-end full system warranty for the rooftop solar PV systems. Quickly, what we're going to cover today is what I've listed here on this page. I'm not going to read each one of them, but we will just jump right in and get to the essence of financial models. Before I get started, the difference that you'd see between Ankit's presentation and my presentation here is I'm going to be mostly focusing on how we have been using financial models in our day-to-day job and as we sign up customers and projects and so on. So that's going to be the major difference on the utility of these models. So I'd like to start with the basic grain of what a financial model is. And the best way to say that is what it is not. It is not a magic 8-ball that's going to come and give you the answers you're looking for. It's a great tool, but it takes a lot of thoughtful inputs, and thoughtful inputs range all the way from technical inputs in terms of the solar PV technology, the inverter technology, your collection system, your overall losses, and they all play in. Into the model, and then you take the physical aspects of the location, coordinates, and the solar insolation and the climate for that specific project, and then come in the commercial aspects in terms of is it going to be an all-equity deal or if it's going to be a leveraged project, and if it's leveraged, and what is going to be the debt term and tenor and the rate, right? And the easiest thing to do with these financial models is to always be tempted to put the best foot forward. So any fictitious assumptions obviously is going to give you the best results in terms of outputs, but that is actually something to watch out for. Okay, and what we have done with the financial models is we have gained a lot of insight into the sensitivities of the various inputs, and these inputs go all the way from sizing the cables to spending a little bit more on durable products that go into the projects. The one thing to always have in mind when working on a financial model, as also working on your projects, is as a developer, we always feel that we are at the center of trying to satisfy initially the off-taker, and once you've satisfied the off-taker, then looking to convince investors and or lenders to participate in the project and make sure that it's a win-win for all four that is involved. And what are the ways in which financial models could help? You know, being specific to our company, you know, I have a lot of background in private equity funded independent power producer back in the U.S. And we run probably the most complex financial models there, and run, you know, dozens of scenarios to you know, look at the project's potential outcomes and identify boundary conditions. But having started this new company here, while I'm very familiar with the technology and projects and the economics and whatnot, the reality of the Indian market is quite different than the reality of the market in North America. So this financial model that we used here was a great tool for us to actually you know, prepare prior to project execution. But where it has been most helpful for us is actually as an investigative tool, where post-project completion we go in and we tune up and true up our financial model, and that, you know, it's been a great, valuable educative tool for us to quickly correct our models and assumptions and whatnot. Yeah, it's a great tool to investigate and also establish the baseline economics for a given technology. You know, the economics for thin film solar is different than the economics for monocrystalline versus polycrystalline, right? So we would establish baselines for each of these technologies, and then from that point on, we just run sensitivities on that. And we have used the results of our financial models for discussing with potential customers and you know, investors. We haven't approached lenders yet for our projects, and it's very important for us to actually openly sit down and discuss with our customers and investors, because given the durability of our projects, we are actually not the cheapest rooftop solar installer in the market here. You know, and so we use the financial model to actually demonstrate to our customers why the initial higher capex is more than offset by the lifetime return of the project. Okay. And then, you know, obviously I've already talked about understanding the influence of the different inputs, and then also establishing boundaries for the projects. So some of the key model inputs for a rooftop project or even a ground-based system, the key ones are, you know, capex, what is going to be an overall capital expenditure on the project, and if there's going to be a debt component to the project, capital needs, and if so, then you know, what are going to be the equity returns and the tax appetite for both the equity investor and the lenders, right? And these are the key things that impact getting into the project. Now, once you satisfied your off-taker and you're able to put a project together, then you really need to sit and think through your actual project implementation. And for that, you may need a construction bridge loan to take care of your construction phase of the project, and then figure out what your operating expenses are going to be. And one of the things that, or at least I've talked to a lot of developers here in India, and they seem to overlook or not pay a lot of attention to, is the working capital needs. And within working capital needs, I also lump in the operating reserve requirements in terms of cash reserves. And then a big factor that plays into your OPEX and also future replacement costs is the inflation aspect in an economy like India, where the targeted inflation is probably going to be somewhere between 4 to 6%, that is something to definitely watch for and spend some time on. And then there's this obvious tariff escalation. At Suitless, we have done a lot of work backcasting and forecasting tariff escalation, primarily in Tamil Nadu, and the numbers are mind-boggling. And we use these analyses to again incorporate or update our assumptions in the models, and we also share that with our customers. And the last thing to note for note of here is the salvage value, right? You can take any project that has bad returns, and this one number, you could just tweak it, and you will be able to get a target return on the project. But then it's also going to cut the other way around, is you may not be able to realize the expected return because you're not going to be able to realize the salvage value or terminal value. So that's definitely something to watch out for. And you'll see in this slide again, I have this triangle with these three players in a project. And for every one of these slides, it is important to always keep in the back of your mind that, it's a tool to help the developer, build the case, to convince the off-takers and make sure that the investors and lenders are going to be happy. So it's just this triangle that keeps going on and on into all of these analyses. Okay, but all said and done, the most important thing is to understand, as you're tweaking and playing with this model, I'm pretty sure once you start getting into playing with a financial model, you will quickly find out there's at least 100 variables that you, as an analyst, could put your fingers on, and they all affect the outcomes in different ways. But then these are useful tools and levers because as a developer, you definitely need to be critically aware of the impact of each one of these 100 levers on the final outcome of the economics of the projects and the return expectations and the risk associated with the project. Yeah, a good example is CapEx variability, right? But to a large extent, unless you have a huge foreign exchange exposure, you would be able to nail down your CapEx variability. Sometimes what is not paid attention to is also about schedule extension. Developers have this tendency to assume that if a project gets delayed, the entire project is going to get delayed, and so you just push all the deadlines or your project milestones by a certain number of days. But the biggest risk for project implementation is going to be schedule extension, where you've started the project, but then you're getting delayed in completing the project. And that could be, even for a rooftop project, you need to have, the safety certificate issued by the Inspectorate General. You need to have the local DISCOMs or the utilities come and inspect and approve your installations. They all could add to delays to the project. And the other key aspect is also identifying delayed receipts, especially, for example, if you're looking at a state like Tamil Nadu for rooftop solar, where there's not actually a payment from Tamil Nadu, this may not be applicable. But then when you're looking at the net metering scheme implemented in Karnataka, where they just started, you will be able to get payments from the state utility, but then you also need to model in a buffer, what if, maybe on year one the payments are on time, but then from year two the payments are getting delayed. So you definitely need to factor in some time for that, so some of the parameters for that. And then the biggest risk for projects would be tax law and regulatory changes. And one example that comes to my mind is, although I haven't, the market here in India is a little bit immature in this aspect, and that relates to transmission wheeling charges. And this is a huge risk for all large-scale projects that are remote to the consumer and where they have to incur wheeling charges. In today's world, where renewable is being promoted in a big time, the transmission wheeling charges are subsidized and actually have even been removed from being an obligation on the project developer. That's a scenario that might change 10 years from today, right? And if that changes, transmission wheeling charge could be a deal breaker, and this is going to be a time when, if you look at projects today, if you have a 10-year term for your debt, and depending on where you are, if you're at year 8 or 9 or whatever, and then bam comes this new regulation change, that could derail your project, because you may not, you're going to be so close to wrapping up your debt, but you may not be able to last that 1 year because of severe cash crunch, right? And then the next one obviously is tax treatment, whether you're going to be able to get the tax treatment you expect to get. And a big aspect here is going to be completing the project to get the full annual tax rate, meaning I think you have a September deadline prior to which you need to have the project online to get the full depreciation benefit for that given year. And then the next set of 4 points I have to the right, again, are technical aspects of the risks, and these are climate variations. This is something that I personally experienced this in one of our projects in the U.S. We built the largest wind plant in North America. It was a single plant at 1,500 megawatts, and on a year-over-year basis, we had a 1 year which was not as windy as the historic 30-year data we used, and that was a huge hit on the economics of the 1,500 megawatt project. But that's something that you always need to be watchful of and run your sensitivities on, whether you do it as a P90 or take it all the way to P95. That's something that you need to run and work with your investors and lenders as well. Maintenance overages are another aspect. When we came in here in this market, we started with really high maintenance charges, but then on our side, we had to do the other way around. We had to tune our maintenance cost down because we came in with a higher assumption. The other two aspects which are key would be, and I think Ankit talked about, the power capacity laws of the power degradation of solar panels. That is a big risk factor. And then also the inverter replacement. Every project by default has a scheduled inverter replacement at year 10, and this is for the big central inverters. Now, you definitely need to run a sensitivity on, what's going to happen if I have to replace my inverter in year 7, right? So these are some of the key ways in trying to incorporate risks into the model, and then try to find out how your project is going to be affected by each one of these. And not every one of them are going to be critical to your project, but you definitely want to run this to set your boundary condition. And once you have your boundary condition, then you can identify, okay, which one of this is my investor going to be very sensitive to, and which one of this is going to be very important to my off-taker as opposed to the lender, right? But all said and done, I think the one thing to always have in mind when you're working on the financial model is if you're an analyst working on a model, you're probably a person that loves numbers and playing with numbers. Make sure that you're not using your inherent bias in trying to produce good numbers. That's a great thing to have in mind when you're running numbers, because as you start tweaking the numbers, version 25 of your run, you probably have lost track of all the assumptions that you tweaked a little here, a little there, and that might have a significant impact on your final numbers. And so you run this model, and it comes up with a big, list of numbers and metrics and so on. And so what? How are you going to deal with it, right? As developers, we here, what we do is we run a whole bunch of numbers, and we run some numbers that are not actually defined in the textbooks of financial metrics as well. We run all these numbers, but we don't necessarily think all the numbers are relevant to all the parties. If you're looking at a lender, the lenders are probably interested in looking at your debt coverage ratio, right? If you're looking at the investor, depending on the type of investor, if it's an investor that's just looking at cash flows because they need an equivalent of a dividend payment, these are investors that don't really care about IRRs. These are just investors that care about the cash flow and the cash flow metrics. Whereas if you're looking at investors that are interested in the project to take advantage of tax incentives or depreciation benefits or whatnot, then they're probably looking at IRRs, the NPVs, and the modified IRRs. Okay, and at the end of the day, the off-taker just doesn't care about all of these things, because all they need to know is, okay, you put the system here, how much effectively am I paying for every unit of energy that I'm going to be using? So that's all the off-taker is going to be concerned and looking for. Okay. So I know I have a bunch of acronyms here, but they're all standard industry acronyms in the financial terms, and you should be able to find something. Maybe Google it if you're not already familiar with it. And the leading thought on this one is, there is a ton of numbers, and financial models are built for giving answers to every party that you're going to be able to come across, but it doesn't necessarily mean that all the numbers are important for all the parties involved. An off-taker is going to be happy knowing the effective cost of energy. But the off-taker could care less about debt service coverage ratio or whatnot. So I want to leave this slide with that thought on. And so here's an actual case study we used, and it's a very cryptic description of what this case study is. So if you actually read through with me the top two lines, it's a residential rooftop solar PV project in Tamil Nadu. It's being designed for a customer that has an average consumption of about 1,000 units a month. And we have designed the system to offset 82% of their grid consumption, 82% of the 1,000 units per month. And the system modeled here is a capex of 79,000 per kilowatt, and it's an all-equity structure. And this model is run for 25 years. Now, just to give you an idea, we usually run multiple scenarios, but here I've just shared 3 scenarios we ran for the customers because subsidy is the biggest question when we go to a customer, and M&RE subsidy, for example, we run 3 scenarios, in which in this case we ran were 0% subsidy, 15%, and 30%. 30% is the most recent number that's been restored in terms of M&RE subsidy, and 15% was what it was last year, and 0% to represent the chances that you may not even get the subsidy. And so what you find here is a whole bunch of numbers, and since this is an all-equity analysis, I've grayed out about 9 different values on the table in the left, and these are all cash flow related numbers. Since this is an all-equity deal, they're going to be the same no matter what the scenarios are, whether you get the M&RE subsidy or not, because the cash flows are based on avoided cost. Since in Tamil Nadu, it's a net metering scheme, the return on investment for a rooftop solar project is on the avoided cost of not using the energy from the grid and avoiding the payments you have to make to the grid here. So what you find is a differential of about 3% between not getting a subsidy with MNRE and getting a 15% subsidy. However, if the customer is able to realize the 30% subsidy that is in effect right now, then the effective IRR for the customer is about 23%. That's a huge, huge difference for the customer. And we present these numbers so the customers, in turn can understand how much importance to pay to get this MNRE subsidy and work towards that. And the cash-on-cash return, when you don't get any MNRE subsidy, for example, in this case, is about 11% on the investment, and that goes to about 16% when you do get the subsidy. And in terms of your cumulative cash flow, which again is a cumulative, avoided cost or avoided cash payments to the grid, it's about 25 lakhs. All these numbers, other than percentages, are represented in lakh rupees. And the NPV of this project, the NPV of the project, NPV again is net present value, and that's one of the numbers that I've used as a critical value in assessing projects in my whole life. And if you look at that, the NPV of the project goes from 4.7 lakhs to 6.1 lakhs. And NPV basically communicates how much value is this project worth in today's dollars for the investment you're making, taking into account the invested dollar. What this means is if you're making an investment, and for this specific case the investment is about the investment is about, I think, 4.9 lakh rupees. For an investment of 4.9 lakh rupees, the return of this project, even if you don't get any MNRE subsidy, is about 100%. And that is taking into account your investment. So that's pretty sound economics and a strong case to go for a rooftop solar project, for this particular project. And then in the lower row, you have the levelized cost of energy for the different scenarios. And again, since this is for Tamil Nadu, this will obviously be different for Karnataka and Andhra Pradesh, and for the different utility territories that are out there. And here, this case again is a sample case that I created just to demonstrate the numbers based on the prior example. So here, I took the same consumer and made an assumption. What if this consumer is located in Karnataka instead of Tamil Nadu? And the first two lines here identify the changes from the prior case. So the customer is assumed to be in Karnataka, and the MNRE subsidy is 0% for all scenarios. And the reason we selected 0% here is in Karnataka you have a net metering scheme that pays you about 2 rupees per kilowatt hour or unit higher if you do not claim MNRE subsidy. And it's a no-brainer. It makes sense to not claim. So the first scenario, we are assuming that the generation from the solar plant is 5% lower than what has been expected for that geography. Okay, and then we also assume that a scenario where the project is levered up to 80%, and given the high leverage for the project, the debt assumptions are 12% interest rate for a 10-year term with no deduction. The second scenario, again, just a change in the leverage. where we're studying it at 50% leverage. So given the higher equity drop into the project, you are able to get the benefit of a lower interest rate, marginally lower interest rate of 9.5% and 10-year term. Again, no depreciation. And then the third scenario we ran was assuming, what if this person wants to take advantage of accelerated depreciation by, dropping this project into a company that is profitable, right? So in this situation, again, what we're doing is for this changed condition, we're assuming 120% capex instead of 100%, same 50% leverage, and 9.5% interest rate, 10-year tenor with accelerated depreciation. Okay, and then we ran the numbers, and the biggest difference between what you see here in this slide and the prior slide is the prior slide is all equity, so that you don't have an interest or debt service drag on the project. Okay, so here on all scenarios you have a huge drag on these projects because of the debt service, and we can walk through that. Now, if you look, obviously the no-brainer part is the first project, the first scenario where you have 80% leverage at a high interest rate and a 5% lower generation. In this case, obviously you see that you are not cash flow positive on the first year, right? In the chart you can see there is one little bar that goes below zero for scenario one, and if you look towards the table third from the bottom in column one, you would see that the free cash flows are negative, which means that this project is not making money in year one, and subsequently it does make money, because you can see that the second row from the bottom, which is the free cash flow cumulative, which is about 16.5 lakhs over the lifetime, which is 25 years. Okay, and then for the second scenario where you have a much lower leverage and a favorable interest rate, you do see that the project is cash flow positive, and the levelized cost of energy has improved by 80 cents or 80 pice per kilowatt hour, and the NPV has increased significantly. Okay. And then the third scenario, which in this case is a scenario we think is likely, because we have talked to a lot of customers in Bangalore who are interested in dropping solar projects into their company portfolio, which is profitable. And under this scenario, you see that the IRRs on these projects are about 14%, and the net present value is about 3.2 lakh rupees, and the levelized cost of energy is 3.4 rupees per unit. Okay. And this is based on the payouts from the utility for any overages, right? And so in this case, the cumulative free cash flows are in between scenarios 1 and 2. Okay, very close to scenario 2. So now moving on to the different business models that have a huge potential for solar is the obvious one is the outright sale. At Suitless Energy, given we are a startup and we want to establish ourselves in this market, we primarily focus on the outright sale right now, although we are having discussions on the next two, which are the BOOT model, which is build, own, operate, and there are cases where the variation is you build, own, operate for some years and then transfer it. And then the leasing model. These are two models we're actively working on, and we're trying to figure out a repeatable financial structure for us. And the others that I've listed here in green are models that have a huge potential to accelerate retail solar. And what I mean by retail solar is these are, there are only so many 1,000 megawatt ground mount solar projects you could have. They're going to involve huge investments in terms of the power grid, because you are installing them in remote corners of the country and having to transport that to the load centers. But these these five that are highlighted in green, they have a huge potential to unleash solar right where the demand is. And that's why I think that over the next few years we're going to see some of these models come up. Pay-as-you-go model. This is a model that's I think catching up in India, or at least starting in India, but it's a huge model in Africa, primarily because of the off-grid nature of the system there. But I don't see any reason why pay-as-you-go model is not applied to the metropolitan and urban centers in India, where primarily you just it's like a lease model, but it is from an investor perspective a more risky proposition than a lease model, because there's no long-term contracts here. And the next aspect, which is the renewable generating companies. I think this week we all became aware of the groundbreaking rules that have been proposed in New Delhi, for example, or Delhi actually, for allowing community solar, rooftop solar projects, and then virtual net metering. These are concepts which I think will quickly lead to companies that are not the traditional utilities. These are companies that are just going to be retail producers and distributors of green energy in communities. And crowdfunding, that is something that has a huge potential in India. I've seen that really result in exploding markets in North America, primarily in retail solar for developers. And the way it works is there are companies that actually aggregate investors, and these are small-time investors that pitch in money and with their own risk appetite and return expectations, and the aggregating company then identifies the appropriate projects in which the investments will be dropped into based on the developer profile and the end user profile or end customer profile. It is nothing but the Ola of financing solar technology or any renewable energy technology. The other next one is tax equity funding. This is a model that doesn't exist in India, primarily because there are no tax pass-through entities allowed by law here, whereas this is actually the primary mechanism of funding solar projects or renewable projects in countries like the US, where there are entities that are basically tax pass-through entities, so that the risks and liability associated with the projects are shielded. However, the tax advantages can be passed on to the parent. The last one here is is actually a developing model in North America, and I think it may be there in parts of Europe as well. And this is the PACE model, or property assessed consumer energy model. And what this does is, in the local municipalities or the local governments or whoever, they invest in solar projects, and the customer in turn has to return the money back by paying a higher property tax. So in a sense, instead of paying 1% property tax, you agree to or you accept a subsidized upfront payment from your local municipality or the city government or whoever, and then over a period of years you repay their initial investment through higher tax payments. And yes, so the benefit of this approach is at least in markets like North America, property tax payment is a higher obligation than your bank loan payments. So they could seize your house if you don't make the payments. And so investors see this as a very low-risk way of investing in projects. And they have a lower return expectation because the risk premium is much lower. And that, again, in turn results in best economics or better economics for projects for people that are not able to afford a huge upfront payment. The one thing as participants in the industry we all need to be aware of is rules and regulations can either spawn or thwart evolution in this new energy paradigm. And whether you're a developer or investor or lender or an end customer, always pay attention to what's going on around you in this area that could potentially result in laws that are being passed that actually may be counterintuitive to helping the growth of the industry. And the last slide is the policy view on Tamil Nadu. And so here, Tamil Nadu has a lot of policies, and I think this is a rapidly evolving space. And just listing out the different policies here in Tamil Nadu, in the state actually has a huge program where they've committed to constructing a lot of green homes that do come with an rooftop solar and LED lamps and so on, the energy efficiency plus the green energy. And then Tamil Nadu, like other states, also has a net metering scheme where they allow consumers to replace their existing meters with a net meter. However, Tamil Nadu has, in my view, a restrictive policy when it comes to net metering. They do cap the net solar export to the grid at 90% of your net imports, which I think is a regulatory impediment. And then Tamil Nadu also has a unique state central subsidy program that I believe is still in place. And under this subsidy scheme, the first kilowatt of a rooftop solar project gets a 50,000 rupees per kilowatt subsidy. However, to enjoy the subsidy, you need to sign up for the installation through select installers who have won the bidding process conducted a few years ago. And then obviously there's the central only subsidy scheme, which is MNRE, which I believe now is at 30%. And for people that don't really rely on the subsidy, or don't care for the subsidy, the driver is the high tariffs. The marginal the marginal tariff rate for high energy consumer for residential in Tamil Nadu is over 6 rupee 50 paise per unit, and for the same consumer, if it is commercial, then it's over 8 rupees per unit. So the economics are right there for them, and it makes sound investing sense even without subsidies. And the one major issue in Tamil Nadu, for example, again, in my view, would be that while they've allowed net metering scheme, and they've essentially checked a box that says Tamil Nadu has a net metering policy. However, there is an inherent bias in the system where, in Tamil Nadu, schools and colleges, private schools and private colleges are exempt from the net metering scheme, which means they don't get it. And these are, if you take an urban center or metropolitan area even, the huge land potential is available primarily with private sector schools and colleges. But they have been excluded from the net metering scheme, and that is an inherent bias that is existing right now, and hopefully it might be just a matter of time before that is removed. I know I took a lot of time, but I think that's all I have. And here's my contact information for any follow-up. Thank you.
Hey, thanks, Dinesh. That was, of course, lengthy, but it's quite informative and useful. I'm sure the attendees would appreciate the details that you have shared with them. I think these are details that you generally don't get to hear from the field side. So this is good. I think we have overshot by about 22 minutes. So we will have time just for maybe taking 2 questions, and the rest of the questions that we have received, we will try to get the answers from the speakers and post those questions on the website, and we'll definitely share the link and the Q&A with all the participants. So let me take the first question, and probably just taking it to Dinesh. There's a question about the adoption bias, and if you could explain on it a bit. The last point was not understood. So is it a good thing or a bad thing?
It is a bias against adoption, so it is not a good thing.
Okay.
Private schools and colleges have not been provided with the net metering facility. They're exempt from using the facility. So if you look at a college that is closed for about 2 months in a year without net metering, it doesn't make economic sense because they can't really export to the grid.
Okay. And there's this question, if the solar cost is predicted to decrease in the coming years, would you advise to wait for a couple of years before we invest? So I think this question is both for Ankit and Dinesh. So Dinesh, maybe you want to take a hit on it first, and then Ankit.
Yeah. Okay. Yeah. Thanks. I'll go first, and I would have recommended that approach. If the net present value of projects are close to zero, and what that means is, if your expected lifetime return of the project is just right about where your return expectations are, then maybe you wait another year and your return expectation might be favorable in making that investment decision. However, what we have been able to find is you go with a standard installation, which is the actual case study scenario that I shared. What you'd find is the actual investment in the project is 4.8 lakhs. The net present value of that project over its 25-year life is almost the value of the project twice. And the reason I say twice is the net present value is, and this is without M&RE subsidy, is 4.7 lakhs. And the net present value basically says you are spending 4.8 lakhs today, and accounting for that expenditure over the 25-year life, you're getting 4.7 lakhs excess in today's money, taking into account all the depreciation and all these things. Okay, so you don't have to really wait for sometime in the future to make the investments. The time is today because the economics are there already.
Ankit, do you want to take a shot on that?
Yeah, even like Faiz, I agree with Dinesh. Basically, even if the cost we are talking on a downside, the prices have already fallen from rupees 15 rupees a time to now rupees a low level of 4 rupees, 5 rupees. So even on the downside, it's almost we were going to see 5 to 10%. And to my understanding and my belief is like the prices are going to get stable here. So considering those aspects and considering the 25 years of horizon, it's always good, you can't always get things on the lower side. And even prices falls, your cost per unit with your PPA agreement price is also going to fall in line with the cost of solar. Considering that economies is viable now, and one should like look to invest in solar projects currently.
Okay. And maybe one last question that we take, and this is a bit controversial question, as well as I think some of you have tried to answer that question in the presentation, but the question again is, which state has the best solar policy? So Ankit, you want to take?
I mean, saying which state has a best policy is something you can't evaluate. The reason being it your target consumer depends like what kind of target audience you have. The most important thing like in one of the presentation was also mentioned is look at the power tariffs. What kind of power tariff the person is paying. If that you are able to provide at a lower cost through solar, then it becomes viable. Because in one of the case study I compared 3 states, but for a different consumption level you will see the policies are favorable for different consumer profile. So it's not a single shot we can say one is good. Every state is following more or similar approach. It's more about the tariff structure is going to play an important role out there.
Okay, Dinesh, your views?
I think the answer to this question is going to be different when you wake up tomorrow, and it was probably different had you asked me last week. But the answer for the week, I would say, is Delhi, because they came out with what I'm going to call as groundbreaking new rules that hugely support adoption of rooftop solar PV. If you're not already familiar with it, I think you should try to go and look for news articles on that. It's a great policy, few policies they have enacted or implemented that I think is going to be only a matter of time before other states adopt as well.
Okay. Questions are still flowing in. I think I have to stop here because we're already 30 minutes overdue. We have 1 more minute. So I'll take that opportunity to thank our speakers for sharing their insights on this particular topic. And I'll also want to thank the attendees, the participants who took time out of their schedule and attended this webinar. Nevertheless, we will not leave these questions that are flowing in unanswered. We will definitely add these questions. We'll pass on these questions to the speakers, get their answers, and post this, and we'll share it with all the attendees post the webinar. I'd like to thank again everyone for participating in this webinar and look forward to continue having your participation in our next webinars. Thanks Dinesh, thanks Ankit, thanks all the participants.
Thank you, Faiz. Thank you, audience.
Thank you.